Folks, today we're talking about Disney. Now, Disney's stock price jumped up at a high of 9%. It's currently up 6% today at the announcement that Bob Iger is going to be returning as CEO for the next couple of years, replacing Bob Chapek. Now, here's the thing, folks, and I bring this up in a lot of other videos, that when you see a stock price just jump up in price due to some news, it doesn't mean the company is actually more valuable. You have to really go through the fundamentals. I'm going to go through the stock research app here, and we'll talk about this, because what the software does, folks, it takes a look at the actual balance sheets and financial statements of the company, and it grades this company out of 10. So here's the thing. With Disney, we're ranking this company a 3 out of 10. So what does that mean? It's not doing a lot of things right. So when you see stock prices just jump up for no apparent reason, because a new CEO is introduced, what value is that actually adding to the company? Yes, perhaps in the future there might be some value added with Bob Iger at the helm, but Bob Chapek, I believed, he is torn a strip off of Disney in many ways in one. Disney Plus subscribers have gone down, the share price is obviously taking a tumble, and it's not looking too great. Like, let's go through a lot of this red that's on the board here. They have a high PE ratio on average, sitting at 62.51. So if you on average have to buy this company, even now, the PE ratio is at 56.44. This company is trading at a premium. So you want to ideally find companies that have a PE ratio beneath 22.5, and it's nowhere near that. The current ratio is 1.0. It's not the worst thing. However, folks, we want to find companies that have a current ratio of 1.5 or higher. That would just indicate to us that they have enough assets on hand to cover their liabilities, along with a buffer zone of 0.5. That means they're more liquid. And with the recession around the corner, I bring this up in a lot of my videos, you want to find companies that have low liabilities, low debt, because that's going to increase their longevity. The return on equity averaged, and like, the numbers speak for themselves. You don't have to listen to me, folks, per se, because the numbers are right here. I'm just giving you the numbers. I'm giving you the cold, hard facts. 8% return on equity on average. Trailing 12 months, it's 3.42%. It has been an absolute decline. This company has been doing so many things wrong. Look, the free cash flow is down. The net income is down. They're diluting you ever so slightly, with 0.61% of shares being added to the share count. The return on invested capital is low at 6.40%, and the trailing 12 months is 3.71%. And the revenue growth is up. That's what they have going for them. Their EPS is up. Their debt to equity is low, it's below 50%, and the revenue growth is up by almost 9% over the last 5 years. To me, folks, and what bothers me is that you get articles like this, like, is it time to buy? Is it like, he's back? Is it time to buy? So, like, should you buy? Why? Why should you buy a company that's going up based off no fundamentals? Yes, Bob Iger may be a better CEO at the moment to replace Chapek. I feel like I'm pronouncing his name wrong, but I'm gonna call him Chapek. But yes, he may be the better choice at the moment to replace this individual. But the balance sheets are what they are. You have to understand, folks, that, like, going back into the software here, everything is very, very low. Look, the free cash flow is $3.6 billion on average. That's the last 5 years average. And now it's currently at $1.22 billion. Granted, the year's not over yet. This could obviously increase. But look at what you're being shown on average. 6.40, currently at 3.71. What are the decisions that are being made? Are they sinking too much money into other projects that they're running themselves thin? This software here takes a look at all that stuff, and it begins a screening process. What we're going to do, folks, is find the intrinsic value of Disney. I'm going to input some numbers here in the price analysis section, and we'll talk about it, and we'll see what we should be paying for Disney today. Folks, if you're enjoying the video so far, hit that like button and subscribe button. It means a lot to me. It means a lot to the channel. Ultimately, what I try to provide you is just a clear-cut analysis based off of numerics on what these companies are doing. I don't like to deal with a lot of these other YouTube channels do and just say, oh, but they got this going on and they got this deal happening. No, it's what have they done? What are they predicted to do? Can we put a margin of safety on it and figure out what we can anticipate this business to do? I don't live in dream scenarios like these other people. Before we get down to what we should be paying for this company, take a look at this. I've used conservative revenue growth numbers because look, their Disney Plus user count is down. There's a recession around the corner, so you can't assume that they're going to do like amazing flying through, like the business is going to be flying through. 165 billion or 164 billion dollar company, essentially really garbage financials. I can't assume they're going to be doing well and turn the ship around incredibly quick. Profit margin, I'm using these historic numbers, folks. Here's where a lot of my analysis lies, in the historic numbers of what the company has currently done. I like using these numbers and I put a little bit of a haircut on them. That way I can understand what I can potentially expect from this business from a minimal standpoint, right? 145 for price to free cash flow, absolutely insane, does not make any sense. P ratio is 56.44, absolutely crazy. We don't want to that's too much of a premium. So hence why I did underneath 20. 30% desired return. Put in those numbers in, and look, average calculation comes out to be 32.87. This is the number you've been waiting for. This is the number you've been waiting to see on this video. This is what we should be paying for Disney today, $32.87. It's currently priced at $97.64. So when people say, oh, should we buy Disney because, oh, this person's now back on the hot seat and the stock price rises up like 7%. No, what? That doesn't make any sense at all. This stock price needs to fall down even further for it to be considered a remotely solid buy. It just doesn't make sense at all. Do not buy on the news. Buy on the fundamentals. Buy on the fundamentals. Disney may have potentially been a great buy 10 years ago when the uproar of all these Marvel movies have been coming out. But I think that ship has sailed. That ship has sailed and is slowly dying down. Look at the numbers. It's here. What can you expect from this company in the future? To be honest, I don't think a lot. Anyways, folks, if you want to get your hands on the software, we are developing a mobile version of this software. It's currently in a beta version right now. It's not entirely live yet, but you can use it by going to the links in the description box below. Obviously, the desktop version is available, leodeleo.com. Links in the description box below. 7-day free trial. You can screen any company you can think of across the NASDAQ, North American markets, European markets, Canadian markets. It helps find out the intrinsic value of a company ASAP, understand where the company lies from a fundamental perspective, along with many other tools being integrated and introduced. We also have a charts section, which is phenomenal, which I like to use to see everything a lot more visually. And you can see what is actually going on. And here, look, here's an interesting thing with Disney. They have actually dropped the amount of shares outstanding year over year to 2018, and then from that point onwards, increased the amount of shares outstanding. Terrible business practices, guys. That's absolutely garbage. Anyways, that's the video, folks. What I think about Disney: overpriced. Do not bother with this business. And when people say, when you see companies spike in stock price for no apparent reason, be wary. But usually when it goes up for no reason, there is no valid reason, and it's usually overhyped. So just be mindful. That's the video. I'll see you in the next one.